Well, WeWork is doubling down on its space as a service business with occupancy rising 12% year over year. The company also announced a new series of agreements aiming to cut back on its debt by roughly $1.5 billion. WeWork CEO Sandeep Mathrani joined us now, and Yahoo Finance executive editor Brian Sozzi is sitting in as well. Sandeep, thank you for being here. So you recently did this big restructuring. Where does that position you now going into the next year, 2 years, 5 years?
First, thank you for having me. I really appreciate it. We did do a debt restructuring. One of the items that was hard on was our balance sheet. We needed to sort out to give us the runway. We have restructured the debt by extending it to 2027, reducing our debt on our balance sheet by $1.2 billion. And adding another $1 billion of liquidity. So we have now the runway we need to grow our business and go on the offense versus being on the defense. Our business is, all about flexibility on cost, time, and space. And in this post-pandemic world, all topside occupiers, small businesses, medium businesses, and enterprises are seeking a solution that's complete, that's holistic, that doesn't require any capital investment. So it almost feels as if this moment was created for WeWork as a provider of space. So I think we set up ourselves very well on a balance sheet perspective to get on the offense.
Sandeep, Brian here. Good to see you. And you do mention your shareholder letter out this morning that you do think this is WeWork's moment. To that end, where are you at pulling back on expenses, and when will you hit that adjusted operating profit mark?
So, we've been at adjusted EBITDA positive in December for the first time in the history of this company. We will be adjusted EBITDA positive throughout in 2023. So we've achieved, and revenue continues to climb in 2023. Revenue grew last year, as you know, almost $700 million, or almost 26%. Occupancy grew as well, about 17%. And so effectively, we continue to see revenue growth at a time where we're actually taking demand from traditional occupiers, right? So we control 1% of the market in New York City, and we took 18% of the demand. In London, we control 1.5%. We took 35% of the demand. What that is saying to you is that the occupiers are leaning towards flex space. And so to answer your question, Brian, on expenses, we've been very diligent over the last 3 years since I've been CEO to take out expenses, whether it be right-sizing the organization, streamlining the real estate portfolio, and making sure we're a well-oiled machine. We continue to streamline the company. I would say that, it's a process that never actually ends, and it should never end. You should get more efficient over time. But I would say the bulk of the work has been accomplished. For example, we took SG&A, which we've talked about being at the, almost $800 million at the end of last year. It's going to be in the low 600s this year. So we're taking cost out there. We streamlined our real estate portfolio, and we continue to do that. The beauty of where we sit is we're a tenant. And when assets become obsolete, there's an oversupply in the market, we're able to adjust the supply and demand characteristic. We don't own the buildings, so we're not handicapped by mortgages. We're not handicapped by lenders, putting restraints on providing rent concessions and tenant allowances. We provide a turnkey solution. So occupiers are seeking certainty in this moment in time, and we're able to provide that certainty to them on an immediate basis.
Does the WeWork model right now, and especially in the profitability benchmarks that it's set for itself, does that bake in another kind of drastic shift, if there were to be one, on the definition of what the workplace is, given that the pandemic turned that on its head, essentially?
Well, in many ways, it's exactly where we are, right? So in an environment where people want to come in, they want to come in for a purpose. They want to come in for collaboration. They want to be able to take space that's required. They want to be able to have a cost per head that's more reasonable. Look, pre-pandemic, human resource departments could predict 10 years out what the growth of a company would be. And CFOs were okay with taking on real estate to accommodate growth for 10 years. Today, that's an unknown. And so we provide that perfect solution where you provide 12 to 24 months commitment and you can grow with us. I'll give you an example of a company called Procore. Procore was a company that's a software company that does work in the construction field, and they took office with us in Tampa, and all through the pandemic they continued to grow, and they've continued to grow with us. Again, they took space as needed, and we managed their growth as it went on. You have companies that are going into new markets. Boston Consulting Group moved into Nashville. They opened an office at a WeWork. So again, since you don't know what the future is, even more so today, we become the choice, and we allow members to grow with us. Coinbase, took space with us in San Mateo. So these are all different types of clients that we have that are entering new markets or growing in existing markets, or they have a return to work policy starting in April or May. And for them, they need the space to house their employees today. So effectively, this is our moment. And to answer your question, if there is a hiccup of sorts, we don't know what that hiccup could be. But during a slowdown of an economy, flexibility becomes more the name of the game. I could very well see, and we're seeing it today, that clients would give up their large footprints and downsize. And since they don't know how much to downsize, how the future is, they could very well come into a WeWork. And we've seen that with a large search client in California who moved their corporate headquarters into a WeWork. And so we've seen, fintech companies, who grew as small offices in Paris, a company called Quanto, and they now occupy an entire building with us. So, we're able, the most important thing you have to appreciate a CFO wants is the lowest cost per person. Right. And we're able to provide that by providing, the real estate and also providing our digital products of all access and workplace management. So you can actually optimize the real estate needs and actually lower your real estate costs. So I think, the way we've created our holistic program, it seems to be what the future wants. And look, the largest companies as CBRE and JLL have said that the flex market will go from 2.5% to 15 to 20% by the end of the decade. And if that is to be the case, and we're seeing that in talking to our client base, then actually there will be a supply-demand imbalance, because today a very small percentage of commercial office is in the flex arena. And if you look at the international markets, look at London, Paris, Dublin, Milan, Southeast Asian markets, those markets are already in the 80+% occupancy for WeWork and have very healthy margins. And we've shown the margins in those businesses well over 30%. And so the U.S. has lagged, and we know why, because the return to work policy has been slower and it's starting to change and evolve. And that should benefit from us.
Sandeep, before we let you go, you mentioned some tech names. About 25 to 30% of your tenants are in fact tech, Meta and Amazon. These companies are cost cutting. They're laying people off. What are you seeing from those tenants looking into the second quarter?
So, it's an irony, right? The irony is the headlines talk about the layoffs, but if you actually look at the pre-pandemic workforce of all these companies, and you look at the post-pandemic workforce of all these companies after the layoffs, there has been substantial growth. So the headlines talk about the layoffs. They don't talk about the growth from pre-pandemic to post-pandemic. And if they had to bring these people back into work during the time they were growing the employee base in the pandemic, they were not looking for real estate, obviously, because there was a work from home policy. And so now, as a lot of these companies are insisting people come back, whether it be 3 days a week or 4 days a week or a hybrid schedule, they are all reaching out to find space to accommodate their needs. So until we all figure out what the right return to work policy is, we're actually seeing demand across the board, whether it be tech companies, financial institutions, consulting companies, even pharmaceutical companies. And you never think of a pharmaceutical company as a tech platform. We recently leased an entire floor to Moderna in Seattle, and their rationale was that effectively we want to take advantage of the tech layoffs, and we want to make sure we can hire that talent in Seattle. So actually we think there's more emphasis on the return to work, which will take up space versus the thesis that there are layoffs, because once again, they have more employees today than they did pre-pandemic.
Sandeep, thanks for being here. Good to catch up with you. Sandeep Matrani, alongside Yahoo Finance's Brian Sozzi, talked to us this morning about WeWork.
Thank you so much for having me. Have a great day.